The art of drive-by auditing. The quote is, why did the auditor cross the road? Because he looked in the file, and that's what they did last year. Auditing is a process. The auditors know that. Unfortunately, the consuming public does not appreciate that. They think that when they say an audit report, the auditor has gone and has tested every transaction and is giving a complete verification for everything that's reported in the financial statements. Forget about what the opinion says. Forget about materiality. In my business, what we call the difference between what the auditor does and thinks he did and what the public expects as the expectation gap. And risk management, and a lot of our risk management lectures relate to how you bridge, how you in public practice bridge that expectation gap. But that's for another day. In this particular case, we have the U.S. subsidiary of an international company based in the UK that was in the business, a sleepy little business of procuring and distributing high-end pocketbooks, handbags, and leather goods. And were all branded under the Tommy Hilfiger brand. And it was a business that was operating here in New York. It was, the absentee ownership. The owners of the company were overseas. They did not pay a lot of attention to the daily operations of the business, nor did they care, because it was a business that they had set up and it was running very smoothly and it was kicking out a pretty decent profit year in, year out. The audit for the first year was a fine audit. Usually that's the case. Usually the first year audit, the new auditor on the case does a great job. It's pretty thorough. The problem is the realization on the fees generally tends to be taxed. What happens though is as you go through the second and third and fourth and fifth years, when you have the same audit staff interacting with the same clients, there is a tendency to sort of fall into a groove. And in this particular case that I'm talking about, the audit engagement partner fell into a groove. He assessed, if you read the risk assessment in the work papers, they assessed the risk, the audit risk, as low. And the reason why, when I asked him, is they said, because they had no bank debt. How that translates to audit risk being low or not, I don't know. I mean, usually absentee ownership is an indication to me that the risk is high. But he assessed the risk as low. There was, over the course of the 5 years that this firm did this audit, a huge embezzlement by the controller. He embezzled $20 million over a 5-year period. Now, for a business that's doing $50 to $60 million a year in sales, one would certainly suspect that over the course of 5 years, $20 million missing would show up. Somebody who's doing analytics as part of an audit is going to be able to say, hey, guess what? Why are the margins shrinking? What are we doing other than just checking off the audit programs? What are we doing here? On this particular audit, the audit staff did put in substantial time doing the audit. But exactly that, just checking off the audit programs. Saying, I did the procedures. There was no real analytics that were performed. When the lawsuit came down, the first thing that is typically requested, in addition to the work papers and all the engagement documents, are all the billing records related to that particular engagement. We were startled to see that over the second, third, and fourth and fifth years of the audit, the engagement partner billed an average of 4 hours per year to those audits. He just assumed it was a low-risk audit. He didn't do any work on it. He was happy to collect his fee. It was a sleepy business. He was, not really paying attention to it. The quality review professionals within the firm had many more hours billed to reviewing the audit work papers than the audit engagement partner did. And just think about the optics of that. Somebody is going to be presenting this case to a jury, and the plaintiff's going to say, well, how could this audit engagement partner really have done an audit if his own time records reveal that on average he spent 4 hours a year reviewing the audit work papers and being involved in the audit? That is the classic drive-by audit. It doesn't get any more classic than that. But the takeaway is that an audit is a process. There is this expectation gap that you, as the auditors, are doing much more than what you really know you are doing. And you're going to have that expectation, and the people that are going to be evaluating that are the judges and the jurors and the arbitrators who are not necessarily your friends and who are not necessarily auditors. In fact, they're likely not to be auditors. You take it on. You take on the responsibilities. Don't just check off the checklist. Pay attention. Think. Don't leave your brain at the door. Bring your intelligence with you. That's the importance of your intelligence and your gathering and the expectations. So that's, if you're going to take on these engagements, make sure that you do the job. Just simply checking checklists will not cut it.